Welcome to Fidelity Soundbites, a monthly podcast where investors can tap into Fidelity's more than 400 investment experts who are on the ground around the world so that you have the inside edge when it comes to making more informed investment decisions. From equities to fixed income to private assets, let us help you build a better financial future.
Hello, my name is Lukasz. I'm Head of Strategic Sales and Solutions at Fidelity, and it's been a tumultuous period in markets recently, and headlines have been dominated about what's been happening in the Middle East, notably in Iran, and the impact on energy and markets more broadly. And it feels like day to day, the markets are driven by headlines and tweets at the moment. So it's a very opportune time to really sort of dissect what's happening. And I'm pleased to be joined by Matt Quaife, our Global Head of Multi-Asset Solutions. Matt covers a lot of ground in terms of the macroeconomic environment in his day-to-day job, managing a large pool of assets across multi-asset solutions. So welcome, Matt.
Very nice to be with you.
So, Matt, it has been a tumultuous period in terms of markets, and I'm really interested if we sort of step back and think about the early periods of the current conflict in Iran. What was the first thing that sort of triggered your thoughts, and what were your initial sort of observations when you opened up your screens and up you see, screens go red, oil price jump up? What were your initial thoughts?
These things, you always try to take a step back and keep calm, right? Because we've been through a lot of these types of periods before, and the behavioral side of investing can be quite damaging if you get too panicked by it. So it was a matter of sitting back and looking at both the facts on the ground from the fundamental point of view, but also then where we get to on technicals. We were coming off the back of winter when, there's more demand for gas. And also stockpiles are pretty high in a lot of countries, not universally, and we can talk about that later. But China's got pretty good stock levels, and then we were also coming into it with pretty decent global growth momentum and a falling inflation rate prior to this. So as a backdrop, when something like this hits, that wasn't a bad time for it to hit. If it was, obviously you would never want it to happen. What probably made markets panic even a little bit more in the first days was because positioning was really long in certain markets. There was real bullish spirits in that first couple of months of the year. And a lot of the very popular positions got really beaten up, right? So if you look across the world, areas like gold got smashed, which, people might have been holding that from a defensive point of view. Very popular markets like Korea, Japan after the elections. A lot of people were short dollar. You saw the dollar rally really hard. And other areas where Bitcoin was already down 40% and was deeply unloved, and Bitcoin behaved incredibly well, low volatility, and actually come up through this period. So, the technical backdrop really drove some of the price action. And so for us, it was a matter of analyzing the impact of this and looking across those markets and deciding where the risk is more beneficial than the return potential. Something's overreacted.
And when you sort of reflect on that sort of, very much an energy-led shock, I think most of us looked at the maps in terms of got our geography lesson books out and worked out what the Strait of Hormuz was. But if we sort of think about that energy-led shock and the implications for that, when you looked at your portfolios, what were some of the things you were looking through in terms of your portfolios, how you were positioned? Did you need to change anything at that point in time?
We did reduce a bit of risk and raise a bit of cash relatively early on. That was more of a reaction to the correlations than where we thought markets were going. So we then added back quite early. And so what I mean by that is when you look at general conflicts and oil-based conflicts, if you look at them over the last 50 years, most of the time markets recover inside 6 months. And we've pretty much seen it this time, right? So you have to be quite cognizant of that. Also, with this current administration in the US, we know that there's a tendency to kind of change on a dime policy and not particularly have a stomach for deep impact to markets, especially bond markets where the funding costs will go up. The complication this time is that obviously it takes more than one party to resolve this, hence the position we're in at the moment. So long story short, the big issue this time was the correlations. You got bonds selling off, gold selling off, equity selling off. There's very little places to hide. And so where we needed to protect, because there wasn't, we were getting near risk limits, we took some risk off the table, or where we held options, without naturally taking the risk off the table. And then we kind of sat there for a little bit of time. We added back early April. We were kind of sitting there ready to pull the trigger due to the fact that in general, markets recover within 6 months, and the policy backdrop and what I described going into the war, which is we had enough momentum to get through this. Yeah, it's been a bit of a rocky ride.
And the point around diversification is a really good one because, as you mentioned, bonds, historically, traditionally do act as that diversifier within the portfolios. Over the long term, people go into it because it's slowly correlated to equities. But we haven't seen that at the moment. So obviously correlations have aligned closely in terms of being positive between bonds and equities. And gold, another one, which you did mention earlier on, which quite often is seen as a bit of a safe haven, sometimes a hedge against inflation, also sold off. So, in that environment, where do you find diversification? And I guess if we look further afield as well, as the situation evolves, is this a structural change in what diversification means, or do you think it's more just this point in cycle?
So I'll take the latter point first, and I do think there's a structural change. And if I can just set the scene quickly on this one, because it's worth talking about. If you look at bond and equity correlation back to the 1800s, you can actually see that the correlation between equities and bonds spends far more time in a positive territory than negative territory. And it's actually the time since the mid-80s that is actually an outlier for consistent negative correlation between equities and bonds. And if we just think about why that is, my simple Fisher-Price approach to this is when inflation is more volatile than growth, so inflation's going up and down a lot, they'll be positively correlated in general. And when you've got stable inflation, but growth is going up and down more than inflation, they'll be negatively correlated. And what we've seen since the 80s is a trend down in inflation. We were through globalization, through China's development, through various areas, we generally had a very stable inflation backdrop and quite a low inflation backdrop. And now one could argue is we've got quite a mundane growth backdrop and we've got quite a volatile inflation backdrop. And if you think about the drivers for that, it is deglobalization, it is the political backdrop, it is supply side issues like energy and others coming through. And frankly, over a 5 to 10 year period, I would expect more of that than less, or at least I think it's prudent to plan for it and not assume that we're going back to the world of since the 1980s. And just to make one extra point on this one, this is an area where people are quite blind to this risk because all of the MSCI data starts in 1995, right? Like if you generally go and talk to someone who's doing long-term CMAs and SAA investing, they often take just a 30-year average of correlations, and then you end up with a minus 0.2 assumption between equities and bonds. And that's effectively drawing through a 30-year non-normal period compared to much longer time horizon. So then what do you do about that, right? So assuming that that's where you're at, what do you do? And the hard answer is there's no one replacement for the job that bonds have been doing for the last 30 years. So you have to really think harder. And part of that is deeper diversification. Part of that is you can have more contrarian value bets because they tend to not get beaten up so much in terms of strategies. You can have high quality equities that protect on the drawdown. You can run option strategies that we've been doing very successfully in the last few years, where you run them dynamically so they don't cost too much, but they really help in a more direct way. And the other one is you take a slightly longer time period in your views, and you accept slightly higher drawdowns because, as I say, there are periods like this where there might be a challenging 6 months, but if you shut your eyes and come out the other side, you're better off holding risk. So There's a few ways to do it, including liquid alts and others that I haven't mentioned. And the short answer is you need a bit of all of it to do it well, because there isn't one, secret sauce that deals with this given the situation.
I get the sense also it feels like diversification has become more important now. Like these sort of events highlight that. When the markets are just running hot, investors forget about. But from what you're saying, it feels like it's far more important and more complex maybe that has been in the past. But if we look at the sort of markets, one of the interesting anomalies has been this, despite, I guess, the headlines, despite the volatility in terms of the narrative of the conflict currently in the Middle East, markets, and in particular the US market, has been pretty strong. It's continued to rally. Tech in particular has been a driving force of that. How do you explain that? Because for your average person on the street, they'll be going, well, look, the world seems to be imploding, yet markets are running hard, and and that tech rally continues. How do you explain that?
Earnings and the strength of the cycle. I mean, that's what we certainly seen. And a lot of it is in line with what I was saying before this, in terms of the conditions that we were coming in to the conflict. I would say that one of the unique things about this cycle is that we've got an investment-led cycle rather than a consumer-led cycle. So what I mean by that is the key growth engine in the US is all of the build out of AI and the infrastructure behind that and the demands on that. And that's a really big deal because we haven't really seen that before in my lifetime and probably most people's lifetimes that's listening to this. And what does that mean? We could well have a picture by the end of the year where the employment backdrop is weaker, but the growth is stronger. And we get this big divergence between CapEx and employment, especially given the nature of this. And this means that you want to be allocating far more to real resources, the electrification of the world and these types of things, rather than to, the consumer discretionary side of the world. And so we can certainly talk about which sectors and which regions of the world will benefit from that.
Yeah, maybe that's a good segue into the regions, because it hasn't been all the same across the globe in terms of, obviously the US has done very well, but not all the world has been equal in terms of how it's performed. So from a regional perspective, how are you looking at the world at the moment in terms of allocations, and interested in your view on Australia for the audience as well?
Of course. So we like the US and the tech side of things. And we also play grid upgrade there quite a lot within the US. So the idea that you've really got to build out the electrical grids and you really need to invest to make all of that happen. And so that's certainly an area that we like. We're being a bit more cautious on Europe in the sense that they're quite exposed to this energy shock and need to deal with that on the gas side as well as the oil side of things. We do like Japan. Even though it's exposed from an energy perspective as a recovery play, the policies and the growth are going in the right direction. And so we like Japanese mid-caps and Japanese banks for a more domestic Japanese outlook. And we think that can continue to do well. Some areas we have less confidence in at the moment, but would jump on later if we got a proper resolution, is Southeast Asia. You've got in Thailand, we've been recently visiting there, and you've got, the aircon turned all the way to the max and people working from home and, emergency precautions in place, because whilst I said that stocks were good across a lot of the world, some areas in Southeast Asia were really exposed to this coming in, and they're still, the risk doesn't necessarily match the reward, although maybe when we get certainty, there's a way to go back into local bonds. The good news from Australia perspective is the natural resources angle to this. And we actually think the Aussie dollar can do pretty well off the back as well, especially against the US dollar. You got a bit of a better entry point against the US dollar in general in recent months. And so we like holding Aussie dollars here.
That's great. And I guess one of the questions a lot of people have as well is, what happens if this conflict drags out and there is no clear resolution? And we're sitting here 6 months ahead and we're sort of at the same spot. You've had some of the data come out of the US suggesting there's some inflationary pressure appearing. In Australia, we've had 2 rate rises now on the back of high inflation. If this drags out, what are some of the possible scenarios you see playing out?
Yeah, that's the risk here. And that's why it makes are positioning slightly smaller than we otherwise would. And now that we've had markets recover, we've taken down a little bit of risk. And so we still think our base case is that this will resolve, but we are running out of time at the moment. And so we're watching it incredibly carefully, the situation, to make sure that some of the deeper impacts, such as, jet fuel in Europe and other areas going into the summer, doesn't have deeper, more meaningful impacts. The problem is it could resolve tomorrow and then markets will be off again to the races. So again, we're trying to look for cheap protection in portfolios whilst continuing to hold risk. But the risk there is a more stagflationary type environment where both growth takes a hit to the downside and inflation takes a hit to the upside. I think the one thing I would just say there is that it's quite likely that bonds could change their attitude towards this if that did go much deeper, if we got into that worst scenario, because I think the hit to growth would probably outweigh the hit to inflation over a longer period of time. And so when markets start caring about growth more and, like no one going on a holiday because there's no jet fuel in an area or something along these lines, you could actually get bonds turning around and doing the opposite. And so one of the debates we're having at the moment is, when do we buy the back end of the bond curve or the, kind of the belly of the bond curve? And we're not quite there yet. But at some point we could see this turn around when growth matters more than inflation.
Yeah, no, absolutely. And I think, it's going to be interesting to see what the Fed does in that, if we do see that growth slow down. So if we sort of think sort of from a holistic perspective, and there's a lot of volatility, a lot of news, but, if you were to condense that, and what are some of the top three things you would sort of suggest to investors out there to think about in terms of their own portfolio in this type of environment?
I actually think the AI story that I talked about in terms of employment potentially weakening and CapEx continuing hard is a bigger deal for markets than Iran. Iran captures the headlines, but it's actually some of this data that we see in the background on the divergence of CapEx and some of the other indicators in the market that I think drive things harder. So playing the less expensive parts and the more higher probability parts of that cycle, as I say, kind of grid upgrades, industrial companies that will potentially become a lot more efficient over time, and various areas like that, is quite important going through this. And I think implementing what I said earlier about diversification, so really thinking about the portfolio and thinking, what can we do to diversify our portfolio? And the other thing about that is then thinking about portfolio construction, because basically in all of these instances, correlations go all over the place. So the correlation matrix that sits behind your lovely expensive risk system is pretty useless when you need it at the moment. And so don't base all of your portfolio construction on contribution to risk, assumptions of normal probability and normal distributions. Rely a lot more on scenario and stress tests and working through that rather than kind of classic modern portfolio theory.
That's great. That's some great advice there, Matt. And thank you very much for your time.
Welcome.
If you've enjoyed today's episode, make sure to subscribe to Soundbites on your favourite podcasting platform. Otherwise, if you'd like more information on Fidelity or Fidelity products, please head to our website at fidelity.com.au. Now for some important information. This podcast is issued by Phil Responsible Entity Australia Limited, AFSL number 409340. This podcast is intended as general information only and has been prepared without taking into account any person's objectives, financial situation, or needs. Please note that past performance is not a reliable indicator of future performance. You should consider the product disclosure statement and target market determinations for Fidelity Australia products available at fidelity.com.au.